2 years ago, the Dow Industrials was at 14,000. 6 months ago, it was at 6,500. So we've had a massive slide. If you go back to 1 year ago, Wall Street was basically falling apart. We had Lehman Brothers, which has been a pillar on Wall Street forever, go bankrupt and disappear. We had Merrill Lynch, that was an independent entity, and a mainstay of Wall Street, be forced to be merged into Bank of America just to survive. We had AIG, which is one of the largest insurance companies in the world, taken over by the federal government because they're bankrupt. So we had several of these icons basically go down about a year ago. And when that happened, it looked like the financial world was really seriously on the ropes. That's when the government came out and did a massive infusion to a lot of the banks, and just to try and keep things going. But from there, that was a year ago. From there, things only got worse, because then the politicians got involved, and the politicians started scaring everyone to death. And so after those major collapses, then we went down more to 6,500. So really it was a slide from 14,000 to 6,500, which has only happened a few times in history, collapses of that magnitude. So where we're at now today, this is September, just after the September 30th, the markets have come back up to about 9,800, and they've had a really significant recovery just from March until now, and that's really been an extraordinarily sharp recovery, but it's following an extraordinarily sharp decline. Year to date in our portfolios, we've done extremely well. Our conservative portfolio is up about 11.9% from January through September 30th. And that compares to a 5.7% for its index, which is a Barclays bond index. So in other words, if you just invested in a basket of bonds, it'd be 5.7. Our top flight portfolio is up 27.6% versus 19.25% for the S&P 500. So it's also performed extremely well. Both of those portfolios, if you go back over the 3-year cycle, so you go from January 2007 through September 30th of 2009, the top flight portfolio specifically is back to break even during that period of time, while the S&P 500 over that period is still down, I believe, around 23% for the period. So over the cycle and year to date, we've performed significantly better than the indexes.
The main question out there in the press right now is people are saying the market's come too far too fast. And their question, well, the economy seems to be recovering, the recession's ending, what kind of recovery are we going to be in? A lot of people say, well, it's just going to be sideways or down, or it's not going to be a very robust recovery. You hear that? So it puts a lot of doubts in people's mind. And then, what should I do as far as investing in the market as a whole? Well, if you're wondering whether you should be in the stock market as a whole, we say there's more risk to being out of the market than in, even though the easy gains have just come, because we've just discovered the world hasn't ended. We're all still here. And a lot of companies are still very profitable and doing well on a relative basis. So the market's come back nice. It's anticipating a recovery. Now it's kind of stalling out, and so a lot of people are wondering, well, what from here on out, what should I be doing? Should I be exposed to the market? In the end, we say you should be in the market rather than out, but it's just going to be a choppy ride from here on out. But it's worth your while to still be invested. There's a lot of risk still out there in certain areas, so we're being more opportunistic now, trying to get a little more higher quality stuff in our portfolios that are exposed to the market. But at the same time, when certain areas may get beat down more than others, we'll look to maybe overweight those areas for the short term. So we'll be a little more opportunistic in the market as far as maybe a trading, not like we're trying to just trade in and out, but just as far as different areas that we're overweight. Because when all is said and done, we are coming out of recession. We are going to be in a growth phase. So in a growth phase, you still want to be exposed to the market. It's just we don't know until it's over what type of growth we'll be in. But with interest rates yielding you next to nothing, you're going to want to have exposure to the market. So if someone said, well, should I be in the market or out? The basic answer would be in the market.